All right, everyone, welcome to lecture video for Chapter 6. This is Part 1. And in Chapter 6, we're going to be going into cost, volume, and profit relationships. And this is really where we start putting what we learned in Chapter 5 and everything before, but in particular, fixed and variable costs and expenses and how they are related and used by management to really optimize profits, which in the end is the entire reason we are all going into business, right? So now we're going to put it to use in some real-world analysis. But to do that, first we've got to learn really one basic formula that's going to be expressed many times. And that formula is, in essence, the contribution format income statement. And we'll go into that in just a bit. I thought we'd start off, though, with me just reviewing the handout, which is on the lecture page for Chapter 6. And this is page 1 of the handouts, and what you'll notice is it's pretty ugly, I agree, but aside from that, it's got 7 formulas or equations, right? And you'll see that the chapter differentiates between the two, but what it really has, and what I think at the end of this lecture you will realize, is that it really shows just one equation expressed in multiple ways. And what's more interesting is that that equation is, in essence, the contribution format income statement simply expressed as a formula or an equation. More on that in just a bit, but my advice is that you actually have this handout with you handy, either printed out or on a separate screen if possible, while you're viewing the lecture video for Chapter 6. Without further ado, let's go ahead and get right to Chapter 6. Cost, volume, profit relationships is what we're going to be dealing with, and we're really going to be putting to use into real-world application now the things we've learned about variable cost and fixed cost. So in learning objective 1, we're going to of course, explain how changes in either activity can affect contribution margin and net operating income, which we all know as profit. And first, we want to take a look at that contribution format income statement, which is both introduced to you at the end of Chapter 5, and we're going to spend most of Chapter 6 dealing with the contribution format. So the traditional income statement that we're used to is shown here on the left of this slide. And what it has, of course, is sales revenue, expressed as total dollars, and we subtract from that the largest expense for manufacturing or any merchandising company is generally going to be the cost of goods sold. Once we subtract that out, we come to that subtotal, which is gross margin. And I think we've probably touched on this before, and the book does a great job of it. But margin, you've probably heard in real-world terms as well, just in your own personal lives. That's a common term that reflects exactly that. Once you subtract out the cost of the goods sold from your sales revenue, you are left with margins. And different companies operate on different levels of margin. For example, a large retailer that operates on large volume like Walmart may have very small margins, right? When they sell you a $10 piece of merchandise, they may cost them $8 and they're only profiting $2 off each $10 profit merchandise. Now, what that means is only 20% gross margin for them, but they have such high volume that their profit numbers end up extremely high. Other companies, on the other hand, specialty retailers like jewelers, for example, will operate on extremely high margins. For example, they may buy a diamond for $1,000 and sell it for $5,000, operating at a margin level of about 500%. Not uncommon for jewelers, and even more so. Just a couple examples, and of course there's different kind of models for different kinds of businesses, all of whom operate on different margin levels and percentages. But at any rate, just to make you familiar with what gross margin is, it's really just a subtotal there once we subtract out that cost of goods that we sold from the sales revenue. Then what you're left with is every other expense. And we're talking about general administrative expenses, everything else, taxes, insurance, depreciation, you name it. Subtract that out, and what you are left with is what we generally refer to as net profit, but in accounting world, remember, it is net operating income. And of course, If it's a negative number, then it's a net operating loss. And that the traditional income statement is generally used for financial reporting purposes, right? What we focused on in accounting, financial accounting, ACC 201. Whereas the contribution approach is something that is used more often by managers, right? And this helps us actually increase our profits just by separating out our variable expenses and our fixed expenses. So we don't have the same format. The same numbers are there. You'll notice that it's the same revenue and in the end the same net operating income, but we've separated everything, the operating expenses and the cost of goods sold, into their variable portions and into their fixed portions. That way we have variable expenses first and fixed expenses second. That changes our subtotal number 1 here, and we'll go to the next slide to show you, to what we're going to refer to as contribution margin, right? We're no longer talking about gross margin, but contribution margin. And this format's usefulness, I think, will really be demonstrated in this chapter, not just in reporting it and laying it out like this, but you'll also see in those formulas that we laid out in the handout how important and useful they can be with actually improving profits and for making decisions for businesses. And we're going to do some of that in this chapter, which I think you'll all enjoy. So the contribution income statement is really helpful to managers in judging the impact on profits for changes in things like selling price, in costs, or in the amount or volume that we're actually selling and making. Remember, the emphasis is going to be on cost behavior, right? And so let's focus on that contribution margin for now. Remember and keep in mind just for now that it's the amount remaining from sales revenue after our variable expenses have been deducted. And we're going to break this down a little bit further. And by the way, the example you're looking at here, Racing Bicycle Company, is page 2 of the handouts that I've given to you, so a good idea to have those out. But again, that's just the basic information from the month of June, and you'll also see there's a couple other columns in the handout, and we'll review what those are in just a bit. But for now, I want you to focus a little bit here on the contribution margin and understand that, remember, that's a subtotal after we've subtracted out our variable expenses. So whatever is left by the time we get to contribution margin has to be able to cover all of the fixed expenses if we hope to at least break even and or make a profit, right? Right. Okay, good. Well, for now, let's focus on those top 3 things. Sales revenue, we of course know what that is, right? And by the way, you'll notice that we have in here the volume, the amount that we have sold, the amount of bicycles. So of course, you could very easily come up with the sales price of our bicycles, right? If you just divide the total sales revenue by the number of bicycles that we sold, you can come up with the sales revenue. You can also similarly come up with the variable expense per bicycle, right? Variable expense per bicycle. Simply by dividing the total variable expenses by the number of bicycles that we sold. And that's one thing that I really want you all to focus on, and many of you will get tripped up and this will be a frustration block, so please focus here. Variable expenses, remember, the total variable expenses, as we learned in last chapter, varies based upon the volume. And when we're working with the contribution format income statement, we're talking about the volume of bicycles or whatever it is that we're selling, the volume of merchandise sold. So our variable expenses are directly proportionally tied to the number of units that we sell. So in this example, we've sold 500 bicycles, so you could divide that 150,000 by 500 and very easily come up with a variable expense per bicycle or per unit, right? And the same thing can be done for contribution margin. And that brings us to our next slide. And that's that sales, variable expenses, and contribution margin can all 3 be expressed on a per unit basis. And we get there very simply by dividing all 3 of these by the number of units, or dividing sales and variable expenses by the number of units, coming up with a per unit amount for each of those, and then just subtracting those 2. Spend some time and really understand the relationship between sales, variable expenses, and that contribution margin. And in particular, let's focus in on the per unit numbers at this point. Real important, once you come up to a per unit contribution margin amount, you've got a real important piece of information as to profitability. In our example here, if our company sells an additional bicycle, there'll be $200 of additional contribution margin will be generated. And that can be used to cover our fixed expenses. And more importantly, that's an extra $200 in profit that the company will earn just by selling one more bike. Because by selling one more bike, our sales revenue will go up $500, our variable expenses will go up another $300, and our contribution margin, which is in essence a subtotal, remember, will go up by $200. And our profit, or our net operating income, will also go up by $200. Remember that each month we have to generate at least $80,000 in total contribution margin in order to break even, right? Because we've got to cover those fixed expenses. And in our example, that means selling 400 bicycles, right? If we're selling bicycles at $500, we need to sell 400 of them. That would get us $200,000, right? And if we're selling 400 bicycles, our variable expenses, which are $300 a bike, if you multiply those out, that comes up to $120,000, which would leave us with $80,000 in contribution margin. Subtract out our fixed expenses, and we break even. We're not operating at a loss, and we're not operating at an income at this level of volume. And just by knowing what the contribution margin is on a per unit level, we know that selling one more bike will increase our profit and our contribution margin by $200. This is what it looks like if we sell 401 bicycles, right? Our sales revenue goes up by $500, our variable expenses goes up by $300, and our contribution margin, and more importantly, our profit increases by that contribution margin per unit, that same amount. And every additional bicycle we sell, assuming everything else stays constant, if we just sell an additional unit, it will go up our profit by $200, by whatever the contribution margin is that we're working with. So you can see how contribution margin can really give a manager some excellent information on how and by how much to increase profit simply by changing the volume of sales. Now, the contribution format income statement can also be expressed in the following equation, which is the first equation on your handout as well. And that is basically that profit is equal to sales minus the variable expenses and minus the fixed expenses, which is really just this income statement expressed as an equation, right? Sales minus variable expenses minus fixed expenses gives us that net operating income, or what we commonly refer to as profit. And we'll use those terms interchangeably in this chapter and the next. Remember, we're talking about how managers talk and people internal to companies that are trying to increase profits. If we plug in those same numbers that we have down here, you get the exact same result. And one thing that I really want you all to take away from this chapter in particular is the real world value that's out there. When I say managers can predict this stuff, let me tell you that in real practice, managerial accountants and cost accountants are very limited in the field and can earn really high incomes because they can help managers gain profits. And I don't need to tell you that if you can help make company profits soar, you will be very well compensated. And that's what we're talking about here, folks. Big dollars, right?